I published a post earlier today discussing my weekly trades through Thursday, May 15th. I discussed buying 12,000 in principal amount of investment grade corporate bonds, $5,000 in principal amount of the 4-month Treasury bill at last Wednesday's auction, and about $1,300 in common stocks. I am now alternating each week between buying 5,000 in a Treasury bill and 10,000 in a Treasury bill. I have entered an order to buy 10,000 in the 6-month Treasury bill at next Monday's auction. The 4-month Treasury bill was auctioned on Wednesday at an investment rate of 4.36%, which is near the midpoint of the current federal funds range of 4.25 to 4.5%, which in my opinion signals an investor consensus that there will be no Fed rate cut on or before the July meeting. The CME FedWatch tool closed at a 67% probability of no rate cut on or before the July meeting, and that is down from a 94.3% of at least a 25 basis point cut 1 month ago, and a more probable than not probability that the Fed funds range would be 50 basis points lower on or before the Fed's July meeting, and that was just 1 month ago. The lower probability now is based on the expressed concern by Powell and other Fed members about the Republican tariff taxes reigniting inflation, and that is the reason that investors believe that the most likely outcome now is no rate cut on or before the September meeting to give the Fed time to assess how the tariff taxes are impacting inflation. Also included near the end of my post a snapshot of my cash flow into my Fidelity account on May 15, which is one of my 4 brokerage accounts. I am laser focused on generating a constant weekly stream throughout each week of interest and dividend payments, with bonds and treasuries maturing every week that I will then reinvest in more of the same. I did discuss selling 10 of my 237 shares of the permanent portfolio mutual fund that has an unusual asset allocation. I discussed that fund in a prior YouTube video, which I will link in the more section below. The asset allocation will generally hover near 25% in gold and silver bullion. The fund also maintains a relatively constant allocation to U.S. Treasuries and investment-grade corporate bonds, Swiss government bonds, and close to 40% in stocks. I view the allocation to Swiss government bonds, which is close to 8% when I last looked, as being unfavorable and undesirable from my point of view, since those bonds yield almost nothing, and the Swiss National Bank has engaged in a jihad against the Swiss franc for almost 15 years now, using negative nominal rates, sometimes deeply in the negative territory, to make the Swiss franc as undesirable as possible. If a manager wanted exposure to Swiss francs, it would seem to me to be a better option to just buy dividend-paying Swiss stocks like Novartis. I have selected 20 stocks that I currently own where I'm considering paring my current position some. I have 2 preconditions that must be met. The first being VIX movement below 20, which is occurring now, and a sales price for whatever is sold higher than the closing price on February 19th, 2025, when the S&P 500 hit an all-time high. This is primarily to restrain me from reducing my stock allocation given that it's already very low. I mentioned in my post earlier today in a comment that I did sell for the first sale pursuant to those preconditions, being just 5 shares of my remaining 75 shares of Manulife, a symbol MFC, a Canadian life insurance company that trades on the New York Stock Exchange. That was part of a lot that I bought near $11 back in April of 2020 during the pandemic stock market meltdown. I sold those shares at slightly over $32. Also paired later in the day a position in Kinder Morgan KMI that has a very low cost basis as well. It is normal for me to have meaningfully higher dollar positions and short-term investment grade senior unsecured debt, in addition to the dividend-paying common stock positions, which is the case for both of these companies, Manulife and Kinder Morgan. I own more Kinder Morgan senior unsecured debt than Manulife. Consumer sentiment tanked again in the Michigan survey for the month of May. This was a preliminary reading. According to that survey, consumers are expecting a tariff-related surge in prices, notwithstanding the claims of Trump and other Republican politicians that foreign countries and suppliers eat those taxes. The Commerce Secretary Ludnick recently represented to the public that it was a silly argument to even claim that U.S. consumers will pay any of the Republican tariff taxes, an assertion made even though I am reading multiple reports each day about companies raising prices or about to raise prices to U.S. consumers to recoup all or most of the Republican tariff taxes paid by U.S. importers. It is part of the Orwellian world that Ludnick and Trump and the rest of them live in and will always live in. I do not expect a deluge of price increases to show up in the BLS CPI reports until June or July. Part of the reason for that is that many companies imported far more product than they needed in February and March of this year to beat the tariff taxes, and it will take time for them to go through that inventory and final sales. Some companies that have a lot of leverage, like Walmart, will increase prices as Walmart said this last week to recoup the tariff taxes, but will, because of its leverage over suppliers, cause the suppliers to eat, for now at least, some of the Republican tariff taxes. Some businesses do not have that kind of leverage, particularly small businesses, and they will pass on the entire cost to their U.S. customers.